Thank you, everybody. Welcome, and thank you for being here. I'm Gabriela Pulido, founding partner of Scalto, where we focus on strategy and market positioning for investment platforms and operators across LATAM. Part of my big work is translate complex market dynamics into investment clear narratives, and today I'll be guiding this conversation. So today, we're going to see this from a capital allocation perspective. And we have a very exciting subject joining us today. We have two exceptional voices, Dr. Eli Beracha, Chief Strategy Officer at KBIS Capital and Director of the Hollo School of Real Estate at FIU, one of the most respected real estate economists in the country. And then we have Luis Armando Llanes, CEO of KBIS Capital, who brings the investor's lens to everything we'll discuss today. Today, the goal is simple. We'll focus on three things: on where we are in the real estate cycle, what's structurally driving that demand, and what that means for how investors should be looking and thinking about positioning today. So we'll keep it high level, practical, and grounded in data. I think Dr. Beracha has a lot of insights to bring in, as well as Luis and Luis Armando on the Q&A. We have this discussion, and then we open the Q&A for your questions at the top of the hour, or at the end of that 30 minutes, I guess, that we have in this conversation. So, Dr. Beracha, let's start at the top. In one sentence, where do you think we are today in the real estate cycle?
Okay, so when people speak about the real estate cycle, and if you ever study real estate in a formal way, and maybe we can have the slide on the screen. If you ever studied the real estate, formally, you know that basically there are 4 stages to the real estate cycle. So we're talking about a recovery, expansion, hyper supply, and then a recession. Then it goes back to recovery, etc. That's what you call a cycle. For those of you that maybe want to be a little bit more technical, sometimes we actually skip one of those stages. Sometimes some of them are more pronounced than other. But I think it is pretty clear that if you're really talking about those 4 stages, we're now what we call the recovery stage. We had a correction in the market since interest rate went up in 2022, 23, and they rose dramatically. It affected less the residential real estate for people that buying a home, but in the commercial real estate, it has a very significant effect. And prices corrected by about 20 to 25% on average, depends on what sector you're referring to. And recently, you saw some beginning of recovery. So the bottom is behind us. Interest rates are, stabilizing and stable for quite some time. They're not as low as what maybe some people would like them to be, but they're definitely stable. And the markets start climbing. Again, depends on the asset class. Some do better than others, but we're definitely in the beginning for recovery. And again, starting this cycle once again.
Yeah,
that was more than one sentence, but I'm sorry.
No, but it makes so much sense.
Yes. Eli, I would like to add something that I think it's very important to look through the noise, okay? Because there is a lot of noise out there in the media, but the data shows in a very, very clear way that where we are in the cycle, okay? I think this is very important. There are very, very strong indicators from many sources, okay, that we are at the recovery phase of the cycle. But more important is that it's quite clear that getting in the market at the recovery phase is typically the best time of entry. It's where we really tend to get the best adjusted risk-adjusted returns. It's very clear. There is a clear consensus around that. So despite all the noise, I believe the market is giving us a once-in-a-cycle opportunity.
I'm going to hold that because those are the opportunities that you're going to tell us about. So let's go one level deeper, Dr. Beracha. What is the underlying data, like Luis is saying, telling us about the health of the real estate market today, especially in multifamily, say?
Okay, so like I said earlier, so yes, we are going typically through those 4 stages in a cycle. But this last time we went basically with hyper supply was very light. We didn't really have hyper supply, especially not in multifamily. We had a period when we built more than any time in the past, but we still have a severe shortage of housing. So again, the slides in front of you, what they're showing is that in 2024, we built more apartments than any time in the past, and that's what you can consider a hypersupply. But the effect was actually not as pronounced because we built less of other things. We built less of single-family homes, and it also came at a time of after building very low amount of inventory for many years. So this hypersupply was very short-lived. We didn't have a recession. We basically just have kind of a flat economic conditions, and then now we are in the recovery phase. So that is from the fundamental perspective. If you are looking at how many units are being built right now, it is very low in historical standards. And how many units being right now, it tells you how many units are going to be finished 1 year, 2 years, 3 years from now, depends on what is that you're building. And this actually quite encouraging because even though the market is, again, depends on where you're at, is recovering, we don't see too much supply getting into market. And in housing, it's not like you can just drop supply from nowhere from today to tomorrow. It takes time to provide units to the market. And those units are not going to be plentiful in the coming years. If you go to the next slide, please. Overall, again, staying on multifamily and housing in general, if you're looking at the graph on the right, we are now at a severe shortage of housing in the United States in general. That is not just multifamily. That is talking about all house units. At the end of the day, people need a place to live. They need to live somewhere. Mm-hmm. If you're looking at the year 2000, where the market was balanced roughly, and looking at those bars, the blue bars, it shows you that in the year 2000, 2001, 2002, all the way until 2006, basically, and even 2007, we overbuilt. So we built more units than what we need in order to support overall population growth, household creation, etc. And then we know what happened. We basically have a surplus, right? I mean, so all those blue lines together that accumulate that orange line, we had a surplus of about 3 million units in the United States. And then we know what happened, right? I mean, we had a severe recession. People call it the Great Recession, basically stimulated by these housing surplus. Housing prices collapsed. We know the story. And then we stopped basically building. So then you start seeing those blue lines going down. That means we're building less than we need, and we did it for a very long time. Around the year 2011, 2012, we're balanced and still continue to underbuild. Right now, we have a shortage of about 4 million units. It depends which source you ask, but almost all sources will tell you a number that is somewhere between 3.5, 4.5 million units of shortage. So that is, again, supportive of our recovery. And one last thing about the slide, I guess, or the same slide, but to the left, is the fact that the gap between the cost of rent and the price of the average monthly mortgage payment that is necessary to sustain a home, it grew substantially in the last few years. So as home prices rose significantly and at the same time interest rate went up, it became very unaffordable for many to be able to make a mortgage payment, let alone to come up with a down payment for a house. And then many of them are renters. So we have lower home ownership rate. Many of them are renting for longer. And that, again, is supporting of the fundamental of multifamily.
Excellent. So, Eli, I would like to reinforce that, saying that, yes, indeed, there are strong fundamentals, okay? So the demand is resilient, okay? Remains resilient. Vacancy is reducing, okay? Rent growth is accelerating by the end of this year, okay? Transaction volume is up 27%. Lending conditions are improving, okay? And cap rates already peak. And there is an expectation of modest compression in cap rates. All this combined, what we have said is give me a strong indication that the fundamentals are very strong and the market are very corrected, which is, I would say, a very positive combination.
Yeah, I think most people are not aware that we had a correction that is almost as large or almost as steep as the correction in 2007 to 2009 in percentage terms. The correction then was probably 30-35% on average, and now we looked at 20 to 25%, not quite as big, but it was very quiet. And the reason it was so quiet is because lending condition at the same time supported whatever prices are. Many people that own homes only develop equity. So this last correction was a lot quieter than the ones before, but it still happened. Prices still came down a significant amount and give them the ability to rise from this point on. If you go, just kind of, I guess, finishing on this point, if you go to the next slide, one more, please. The one on the right will show you that home ownership rates did come down. So again, around 2006-07, the height of the housing bubble, it was around 69%. Historically, it was averaging about 66-65%. And now we're at about 65%, which is slightly below long-term average, but it's coming down a bit. Basically, you have fewer people that able to buy new homes because of the price and interest rates, and also some people that can buy a new home, and depends on what generation you're in, people just renting by choice. So all that is supporting of multifamily conditions, in spite of the fact that rents last year were flat, and probably going to be flat this year, to be honest with you. I don't expect significant increase in rent this year, but the fundamentals are such that you're going to start seeing healthy growth rent in the coming years. Not huge, but healthy. And the graph on the left, I guess, support that. As rent prices went up, and that's compare rent prices with median wage, wage kept up and more. So people that are renting can afford the rent on average, of course, and you can continue and increase rent as income increase. It's not like rent is outpacing wage and people cannot afford rent and then you cannot charge them more. You can charge them more rent as they're making more money slowly, gradually over time, which is what you want to do as a multifamily investor.
So what's interesting here is that given the recovery that you just mentioned at the beginning, here's the demand doesn't feel cyclical. It feels more structural in a way. What we're seeing, no? How much of this do you see? I know you spoke about the interest rate, but how much is this? Do you think it's being driven by interest rate, and what happens? I know today they decided to make it no change in interest rate, but what happens when those begin to shift? What do you see?
Okay, so we know that there's the effect of many people on, again, I'm not talking here about the investment side, but I'm talking about in housing in general, right? So the demand for housing increase typically when interest rates come down, and people still have the perception that interest rates were at 3%. Now they're at 6%. It still feels like they're high, even though historically 6% is not high. What's more important than that is the fact that about 2/3 of I guess people that own a home and have a mortgage, they have mortgages that are below 4%. We're now at 6%. To convince those people to sell their home and buy something new with a 6% mortgage, it's difficult. Something major need to happen. I'm not saying it's impossible, but it happened less than it happened naturally. So that keeps the supply very tight. When supply is tight, then prices hold. When prices hold, that means people continue to rent. So that is what kind of keep prices stable, on the home ownership side. And remember, rates went from 3% to 8%, which is the largest increase ever in interest rate that we saw ever in US history. And at the same time as interest rate go from 3 to 8, prices basically did not go down. They went up a little bit in the beginning, stay the same, maybe came down a bit, depends on the area, basically stay flat. If going up from 3% to 8% does not, flatten or, make housing prices correct, very little other things can do that. Now, that means that a lot of people sitting on the sidelines or basically unable to buy will continue to not be able to buy, continue to rent. But if we do get a decrease in interest rate, then yes, some of those people that are now renter maybe will move to become homeowners. That's, I guess, the negative on multifamily. But on the positive side, that will affect cap rates lower, right? As interest rates come down, cap rates also come down. And those that have some knowledge on commercial real estate understand that when cap rates come down, the valuation of the asset is increasing. So either way, we are now in a position that multifamily will benefit from changes in interest rates, regardless of what direction they go.
So shifting towards the opportunity that we have, Dr. Beracha, given everything you're seeing, where exactly do you think we are in the opportunity cycle for investors?
I think so. So we touched on that a bit, right? I mean, so basically after a correction of 20-some%, and I believe this particular graph is from Green Street. If you're looking at different data sources like NCREIF or any of the other competitors, they're collecting data a little bit differently. They have different assets in the data set, but the picture look basically the same, maybe slightly different, but the large picture is the same. We are in the beginning of this recovery. Most people typically want to get in when everybody is getting in. So during the expansion, and that is maybe, 2 years down the road, but that's typically not the optimal time to get in. That is probably 2 years too late to get in. I'm not saying it's a bad time, but it's a time that you already lost the beginning stage that, you start seeing increase in prices, you start seeing increase in rents, and the fundamentals are really pushing you forward. So we are, according to this data set and many others that I follow, that's what I study at the end of the day. I study that for many hours every day. We are in the early stages of this recovery phase, in my opinion.
So the real takeaway here is positioning ahead of where the market is going, and as opposed to waiting to the expansion side.
Yeah, it's a little bit against human nature, right? I mean, people typically do whatever the neighbors do, and they get in when everybody else is getting in. But we also know from history that getting in before the crowd is better than getting in with the crowd.
And how should investors think about real estate today relative to other asset classes?
Okay, so we can talk about real estate as part of the portfolio or how it basically performs relative to other assets. Let's first talk about, maybe focus a little bit about how real estate is doing or expect to do against other assets. If you're looking at real estate in a form of publicly traded REITs, which are very closely tracked real estate prices, and you compare that to the performance of the S&P 500 and the valuation of the two. So the S&P 500, basically a collection of companies from all industries and how they're being priced. And if you compare that to real estate now is the cheapest it has ever been since we have reliable data. We have reliable data probably from the early 90s. And since then, we never saw, if you see, looking at this graph, you see basically 3 standard deviations. For those of you that, I know I see some of the names on the side, some of you are my students in the past, so I'm not going to talk too much about standard deviation, but for those of you that understand that, basically, it is extremely unlikely to go higher than that. Real estate is very, very, very inexpensive in relative terms compared to other companies. So a lot of people talk about, for example, well, is there a bubble with AI and technology firms and all that? That's a side question. I don't want to address it today. But what is for sure is that even whether there is or isn't a bubble in the other part of the market, real estate is significantly cheaper in relative terms. That comes with also a lot of predictability, right? Because significant portion of the return real estate is coming from income, not from appreciation. That it's hard to predict. It helps you with diversification of the portfolio. We know that real estate should be a part of any portfolio. Depends on the portfolio, will be a larger or small amount, and overall has low volatility, especially in the private markets.
Eli, I would like to put it in a different numbers, but the same perspective. Okay, a different approach to see the chart on the left. If we see the returns on the stock market, let's say the S&P in the last three years has been 60+%, okay? And if we see the value contraction on real estate in the last 3 years, it has been between 15 and 20%, depends on the sector, on the asset class. So it's a huge gap. It's a huge gap that is very, very unusual, okay? And for us, like, believe in the regression to the mean, it's telling me that it's a clear opportunity that those two will converge somehow. In other words,
no, regression to the mean is an extremely strong force. People underestimate. Statistics does not lie. I cannot tell you when it's going to go from this plus 3 standard deviation to 0. It maybe go to 4 standard deviation before it go to 0. It's possible, but it will go to 0. In other words, the valuation will readjust and become, normal in relative terms. So that's almost undisputable.
Yeah, I agree with that 100%. And another exercise that we have done several times, and we have talked about that in a one-to-one, is that the long-term average return for S&P for the 30 years has been, I don't know, between 10 to 11%, okay?
Yes.
And the average return for the multifamily core, plain vanilla core, nothing sophisticated, with a 65% lever, which is very reasonable lever, has been between 11 and 14. So it's another data point that confirms that this gap, if we believe in the regression to the mean, that I believe, will be very, very strong direction to follow, okay?
Yeah, I think maybe it's important to note, because a lot of people looking at, cap rates today. So on multifamily, you can get, again, if we're talking plain vanilla, but we can probably get properties, high quality properties for a cap rate, let's say about 5.5%. That's reasonable. And many people are not interested in that, or think that's too low, because borrowing rates are around 6% or maybe around 5.5%, and they don't understand how you can make money borrowing money at 6 if cap rates are 5.5. What they're missing is the fact that cap rate is only part of the equation, right? I mean, you're getting a 5.5% cap rate. And if you are really, and I do believe we're in the beginning of the recovery stage, you should get rent increases at least at 2.5 or 3% per year. That is very reasonable. Now you're already at 8 or 8.5%. If you're borrowing at 6 and your investment is making 8.5, and you're borrowing again 2/3 of the amount, you're now at 12% return. That's without doing anything special. That is basically getting the average investment out there that performing okay. If you are chasing those opportunities that you have something extra, whether it is a value add, whether it's a development project, whether it is a project that you have some kind of a knowledge in or an ability to turn around, then returns, of course, can be higher. But even on a plain vanilla, getting something in the 12-13% returns from this point on, I think it's very attractive.
Jumping in, are there any specific asset classes within the real estate assets that you're most bullish on right now, and why?
Well, it's very different by location. As we know, real estate is all about location. So, but if we're really talking high level, so I mean, we did talk about multifamily that as the overall cycle of real estate. I think multifamily is also in the beginning of the recovery phase, just because we came out of the largest amount of supply ever in 2024, and we're coming down from that. So that's one. Maybe less obvious, medical office buildings are doing quite well, and I think you should pay attention to that. I think you have a lot of support from the demographics, a lot of support from the just trends of people, electing to do whatever procedures and care, not necessarily in a hospital, but in a doctor office or in a off-site location. You should also look at retail. I think there's opportunities there, but you really need to know what you're buying, because in retail is a lot about a lot of losers and a lot of winners takes them all. Because we know from competition from online, many real estate or many retail spaces doing very well, but other ones are doing very poorly. So you need to be very careful there.
Yeah, you should look at our previous webinar where we spoke about the outpatient real estate. It was a very interesting conversation that we had with KBIS.
Yeah.
Luis, let me bring you in here. From an investor's perspective, how should someone be thinking about positioning their portfolio in this environment?
Yes. Well, this is, I would say that we can divide the response, as I shown in the screen, in why now, what to look for, and how to invest on. Why now? I think we touched a few of the key points. Okay, that essentially we are at the beginning of the recovery phase. Okay, because the valuations already contracted, because demands remains resilient, because the rent growth is going to accelerate it by the end of this year, because transaction volume is increasing, because lending conditions are improving, because cap rates has peaked already and tend to have a modest compression. Okay, and at the end of the day is because we are facing strong fundamentals right after the correction. Okay, so everything indicated that this is a good direction. I mean, this big number of 60 years, around 60% increase on S&P in the last 3 years versus minus 20% on the value of real estate is a very, I would say, very tangible and strong indicator. Okay, and what to look for? Okay, and what to look for? I will bring a term to the table that I heard recently, and I love it, which is in the middle of this uncertainty and volatility in the world, I would strongly look for what I call halos. Halos mean hard assets, low obsolescence. That's what we're looking for, something that reduces the risk because there are hard assets and low obsolescence. There are some asset classes in real estate that have the risk of obsolescence, but there are some that, like we say, multifamily or medical outpatient buildings that have very, very low obsolescence. So we love those. Okay, we chase and we look for income producing assets today or after development. Okay, of course we focus on strong fundamentals. Okay, but real estate is very local, very micro. So we will check out the demand supply equation 100% of the time. Okay. So that's what we look for. And of course, the key essential will be the partnership. Who do you invest with? And then I will jump to how to invest. How to invest. Number one, do your homework, discipline, deal selection, and access to the best deals. That is critical. Okay. So invest with the right partners, with better sponsors, people that can really deliver what we believe they can deliver. Okay. And be playing an active management role with transparency and some regulatory supporting. Minimize this kind of risk, okay? And of course, staying on the conservative leverage side of the equation. Make sure you can hold the assets despite any minor correction, okay? So I will insist conservative leverage and look look deep on the fundamentals. Avoid the financial engineering, okay? And at the end, do your homework, okay? I would say that's the essence of what can I say now?
Dr. Beracha, anything you should add there?
I think he covered, I don't want to repeat, I think he covered basically everything that I would say. But people that watch today, and maybe have not invested with private real estate before, I think really, making sure. So when Luis say do your homework, it's, there's two ways to do your homework. You either basically, okay, you're the expert and you make sure that you are really making sure that this investment have the right potential to deliver whatever it needs to deliver, whatever resources you have. And if you're not the expert, if you are a dentist, but you want to invest in real estate, then you need to partner with somebody who is the expert. The sponsors need to be those that have the right experience, that they delivered results in the past, because even though past results do not guarantee future performance, when you are partnering with a sponsor that is consistently performing well in the past, it is more likely they're going to perform well in the future as well. So partnering with the right sponsor is extremely important, and that's basically saving a lot of the homework that you do, because they are the one responsible for that performance.
Okay, we have a couple more segments, but anybody that has questions, please feel free to put them in the chat. So Luis, this becomes less about trying to predict the market, like you said, and more about the halo, selecting the right targets or the right assets, the right structure, discipline, and the right partners. If you will, like you're saying, doing the homework, you can have that in place. So before we open it up and we have more questions in the chat, Dr. Beracha, what's the one thing you want people to walk away with?
Well, I mean, aside from, how to invest with, I think that, we know that real estate should be part of everybody's portfolio. That is it's hard to say with no exception, but almost no exception. Real estate should be part of it. The question is really, what part of that, and how do you want to invest in real estate? So if you want to go the route of investing in private equity, make sure you have the right partner. Make sure that you have the right point of entry, because, whether you're getting right in the beginning of the recovery or getting right in the beginning of the recession, your result's going to be very, very different. So it's important to have a good point of entry, and patient is necessary, right? I mean, don't try to become rich overnight. It doesn't work in real estate typically. Make sure that you have the ability to hold the asset, or, again, join forces with somebody who holds the assets for 5-7 years. That's typical for a cycle, or longer than that if it makes sense. Do not expect that things will necessarily deliver in the next 6 or 12 months. And if, again, you enter the right time, you have patient, and you have the right partner, you'll do just well. You'll do just fine.
And Luis, what's the one thing that investors should have in mind?
Hey, wow. I would say look through the noise. Don't follow your investment decisions on a daily news, okay? And that will lead you to the what I will quote unquote Howard Marks that say it's not about timing the market; it's about understanding the cycle, okay? And we are facing a once in a cycle opportunity that we should not miss.
Good. I think we've covered a lot. Luis Andres, do we have questions from your end?
Yes. First of all, thank you, Gabriela, Luis, and Eli, for a wonderful discussion. And we have some questions that have come in. We'll try to get through all of them. I think we have more than enough time, so we'll spend some time here. So first one, I'll start off with an interesting question that someone posted: is what kind of impact is the war in Iran having on the commercial real estate industry and its fundamentals, and in the economy in general?
So the war of Iran. So, I mean, we know that the war in Iran, so the short-term effect is that you have basically, it affects oil prices, and oil prices affect transportation and cost. It can trickle to everything. And that can be something that may be getting inflation a little bit higher than we want it to be. Long term, and I'm not going to get political here, I don't think this war going to last very long, and I think that we'll end up better on the other side than we came in, and that's overall, positive for the economy and for real estate in general. So I think the United States is generally isolated from the Iran risk now, and it should not have too much of an effect here at home.
Yeah, what I have heard from many experts is very similar to what we are saying, Eli. But in the middle of this uncertainty that wars bring to any nation, including the US, I would say that real estate and halos are a good are a good way to be in the middle of this uncertainty. Okay?
Yeah, so real estate is not being affected by.
I am really sensitive. I would say that wars will create impact beyond what we believe today. Okay, in many asset classes and investment, but this is one of the less subject to impact, in my opinion.
Yeah, I agree.
We can jump to the next question, and this is, I'm sure, in a lot of people's minds, what is the impact that AI is having in commercial real estate? And Eli, we want to hear your perspective from what you're seeing on the macro view, and I can expand on what we're seeing at the KBIS, individual level. With the tools that we're using, we're seeing newer and newer tools and more useful tools come in every day. So definitely our deal evaluation and underwriting process has become a lot faster thanks to AI tools, not only for underwriting the deals and the financial modeling, but also sifting through the inbox. Very, very, very mundane tasks become almost automatic at this point. And with our underlying sponsors at the property management level, it's making enormous changes in terms of, rent collection, warranty, control risk in terms of, fixing a toilet leak. The person puts their complaint on the portal, and the AI kind of manages all the tasks and sends a plumber. On your perspective, Eli, from your side, what are you seeing?
So there's no question that it creates more efficiency. If you really think about real estate, even though real estate has been around forever, we only have data on real estate probably from the early 2000s. So since then we collected data backwards. So now we have as we start collecting data, we also collected data backwards. So we have from before that. But until the year 2000, people that invest in real estate basically invested based on a hunch and a feeling and how business savvy they are, maybe how lucky they are. And as we're getting more and more and more information, real estate became more of a science because you do have data and you're not buying real estate just because, this is a good corner or I believe in this city. You are buying real estate based on, many, many data points that make it a good or not a good investment. And that starts separating the professionals from the amateurs. The professionals, those that really know how to use this data and have access to it, and the amateurs that don't. And then the professional perform a lot better. AI make this gap even bigger. So now not only we have a lot of data, we actually have the tools to analyze this data, because data without being analyzed, it's useless. And again, how you analyze the data, not just create efficiency of sorting through deals, but also making those that actually using AI in an efficient way, again, a step ahead, the amateur that, it's not what they do. So I do see a lot of benefits of, using AI for, again, the team to take advantage of that, and that will continue to be true.
Great. Yeah. Next question, interesting one, because, internally, within the company and in our investment committee, we have, talked about this in the past because we do use CoStar as one of our many sources of information. But someone is asking, based on CoStar reports, forecast deliveries in 2028 is higher than previous periods, while vacancy rates are higher too. So how does that affect our projections? And we've had that discussion internally, especially on how CoStar collects their information. So what is your take on that, Eli?
So there's a few different ways to look at deliveries for 2028, because there are permits that are being issued that you can say, okay, how many permits are being issued, let's say in 2026, and it kind of tell you basically, what's going to be completed in 2028 roughly. But another way to do that is saying, well, what was issued in 2025 or 2024 that was not used, and then maybe that will be delivered. But we don't know that, because some developers that, were issued a permit and didn't use it, they just kind of abandoned the project because it didn't make sense. And some that will deliver on that. And also some of those permits that are being issued right now, it doesn't mean that it will be completed in 2028. the indication that I have based on data that I see is that we see, I'm not going to say very low, but we see probably supply in line with demand. And if you combine it together with the undersupply of housing in general that we have in the United States, it leads us to a point where you just have a healthy market where just enough units are coming in. People not building too much right now with interest rates, with uncertainty, with cost of construction that are still high, etc. Building and making it, developing and making it a profitable venture, it's possible, and we do that, but it's not everywhere. So you don't see too much of these overconstruction. I think that some of those predictions on 28 will turn out being not true.
Sounds good. I'm going to jump to the next. Do you have anything to add, Luis, or can we jump to the next question?
Yeah, I would say I would challenge that comment that Costar mentioned that by 2028 vacancy will increase. That's what I understood, and I would challenge that. Some other sources do not correspond to that, and there are strong indicators that vacancy started to reduce already.
Okay. We didn't talk about office in general, and in Miami, office is having an interesting run. So this person is asking, multifamily is often seen as a strong investment when guided properly, but looking at the Mueller cycle report, it shows office in Miami is in an expansion phase. Do you think office is becoming an attractive asset class again, or are there still structural risks that investors should be careful with? Now, we've had this discussion, and we know it really depends it's on an asset by asset and location basis. So what are your thoughts on that, Eli and Luis?
If you look at office, so of course, for every sector, it depends on location, and of course, depends on the quality of the asset. I think that is especially true for office today, for example, and especially in Miami. If you look at office in Miami, if you have A-class office, true A-class office, you are 100% occupied. And if you're looking for A-class office, good luck, because you're not going to find any, definitely not in large amounts. And when you do find one, you're going to pay a lot of money for A-class office. So yes, I guess if the intention is to develop maybe A-class office and you know what you're doing, maybe there's opportunities there. But then it goes basically, very steep downward from there when you go into B and C class offices. Basically, those offices are not inviting, and those that you don't have to be there, so you can just work from home via Zoom. Those are not doing very well. A lot of them, people sell them as, this office building is selling below replacement costs. It's irrelevant in many cases. Some of those office buildings should sell based on land value minus demolition cost, because an office just does not make sense there. So with office, even though there are opportunities, I will be very, very careful about, where you're building it or where you invested. Another thing on offices, it's the maintenance cost. So for multifamily, for example, if you're talking about CapEx, it's somewhere around 1.25% per year. On offices, we're looking at something around 2.5% to 3%. Most people don't budget for that. They kind of think, okay, so, it's real estate. It's all kind of cost the same to hold. No, it's not. Once you factor in 2.5% to 3% CapEx over time, then that's the technology, elevators, upgrading the space, TI, etc. You need to buy at a very low base to make sense of that investment.
I agree.
Luis Andres, we might have time for two more questions, I guess.
Yes. One, and I love this question in particular. Eli, how does private real estate compare to REITs as an investment vehicle? And when does one make more sense than the other, or for who?
Okay, so when you invest in public real estate investment trust, which I actually think that it has a space in most people's portfolio, and I like REITs in general, you're basically buying the market, right? So if the real estate market is doing well, those REITs will do well, and vice versa. And over time, they're delivering those average returns we're talking about. So if you look historically into real estate investment trusts since 1993, which is when they become in the same format they are today, return is somewhere around 11% per year or so. If you want to have something different, not just like the market, but take an opportunity as of a particular market, there is an opportunity there, or a particular location within a market, or a particular asset class that maybe is not as easily accessible through real estate investment trust, you should go private. So with the private, you basically have access to get to that one deal that maybe do extremely well. Now, the risk is, of course, that also when you're going into one deal, it may not do well. And then that leads me to, if you invest in private real estate, probably you want to be in a fund. So if you have $1 million to invest, I wouldn't put it in one deal, because no matter how well you do the homework and how good is the sponsor, this deal may not pan out the way you expect it to. But if you're getting into the right deal, if you're getting in the right time with the right partner, etc., and now you diversify over maybe 10 private opportunities, so a fund, you will do better than real estate investment trust, because each one of them is a unique opportunity.
Yeah, I would like to add that, I love following the information of REITs versus private markets, because REITs are a great leading indicator about the behavior of the private market. So this is a very nice piece of information that we're very fortunate to have Eli with us, and he's a guy that can translate very clearly to us. But from the personal investment perspective, okay, I think it's important to understand that REITs are typically much larger, typically representing the market, okay? They are liquid, which is very valuable, but also they tend to be a lot more volatile than private markets. And that is very important. More volatile and more subject to, I would say, I will use a word, more subject to the psychology of the investors in general. So you will be, I would say, more sensitive to overreaction from the market if you're invested in REITs. And that's why I tend to like better the private markets in real estate.
Yeah, this liquidity, and I know we don't have much time, but it's important, I think, touching that. The liquidity of the public markets is an advantage because liquidity, we like it. But also for many investors, it serves as a disadvantage because you can sell your assets at any time. And guess what? A typical investor, when they see that the market turned down a bit and they see that their valuation of their REITs is coming down, they get scared and then they sell. When you're in the private, investment, you can't just sell at any time you want because it has a certain cycle. You need to hold it for a few years, etc. And that allows you psychologically to get through those, downticks and then complete the cycle and actually make the investment profitable.
Do we have time for another question, Gabriela? Or
one more, and then we close. We want to close before the hour.
Yes. So how, Eli and Luis, how do you see build to rent, the build to rent sector affecting multifamily, and how do they interact or complement each other?
Well, I think a big part of that, and build to rent right now, as we know, it's facing possibly some changes, regulatory changes of what you're allowed to do and what you're not allowed to do. Are you allowed to build single family homes? Are you allowed to buy them in the market? You need to dispose of them, etc. I think a lot of that is yet to be seen. Even though there are some profitable companies that are in the build to rent space and they can be a good investment, it's still a relatively very small portion of the overall pool of housing. And even if we see some kind of a mandate that they will have to dispose of those assets, or they cannot build anymore for themselves, or whatever is the regulation, I think it will affect those companies a lot, but I don't think it will have a large effect on the market as a whole.
Yeah, I consider personally that build to rent, at least a big chunk of the build to rent market, which is the communities, okay, with amenities and a single administration and I would say, a centralized administration is not very different than a multifamily. Many people, I do call that a horizontal multifamily, okay? So I don't see exactly how much they will affect the multifamilies. I would say this is a subset of the multifamily space, basically directed to people that like a little bit more space in exchange of being farther from downtown. But I don't see a huge impact. It's almost a subset of multifamily, in my opinion.
Well, I do think we're almost ready to close. So thank you all for joining and for the thoughtful questions. It has been very clear. We've heard a message loud and clear that we're in the recovery phase of the real estate cycle. Fundamentals in sectors like multifamily remain strong. And this creates what Luisa and Dr. Beracha is saying. We see a once in a cycle entry opportunity. I'm going to quote you on that. And that we're going to see. This is not the key is not trying to time the market perfectly, but to understand the cycle. Luis, you spoke about the focus on the halos, the hard assets with low obsolescence, and be very selective about partners. KBIS being one of them, structures and leverage. If there's one takeaway, is that disciplined positioning now with the right sponsors and long-term view matters more than reacting to the headlines. This is the signal versus noise that you spoke about. Definitely, we'll be sharing the recording in short clips after the session. And if you have any follow-up questions or want to continue the conversation with the KBIS team, please reach out directly. Thank you again, Dr. Beracha, Luis, and Luis Andres, for handling the questions.
Thank you, Gabriela.
Thank you, Gabriela.
Being here.
And thank you to everyone attending here. Thank you.